In the most recent times, many people have reached out to me to help them invest in the Vanguard S&P 500 ETF. This is really good, and it gives me a lot of encouragement that many people in our community or even in my network are beginning to think about the future or even beginning to invest. However, this also gives me a lot of concerns that many people are simply asking about the Vanguard S&P 500 index and not considering the alternatives. I'm not saying that the S&P 500 is bad. In fact, it's great. Yet, for some people, depending on your risk appetite or your financial targets, there may be other indices that will be well suited, or even a combination of these indices may be a better approach. And so that made me wonder, is it that people are simply asking about the Vanguard S&P 500 ETF because investing is perceived to be hard, and so they stick to what they are comfortable with or they understand? Or even a trusted person may have recommended it, and so everyone simply jumps onto the bandwagon. So in this video, I thought I would explain all you need to know about the S&P 500 ETF, as well as other indices out there that you can consider. And to do this, I would answer 3 questions. What is the S&P 500 ETF? 2, why should you consider investing in the S&P 500? And 3, how should you invest in it? Let's dig in. Standard & Poor's 500 Companies Index, or the S&P 500 Index, is a stock index that comprises the largest 500 companies in America. This means that if you are investing in S&P 500 with a single dollar or a single pound, you are investing in the largest 500 companies in the United States. This is different from buying a single company stock like Apple stock or Tesla stock or any other stock. When you invest in the S&P 500, that money you put in is distributed across those 500 companies. These 500 companies are not equally distributed in the S&P 500 fund. Rather, they are weighted according to their sizes or their market capitalization. Because the S&P 500 includes companies as large as, trillion-dollar companies like Apple to smaller companies like Harley-Davidson. And so when you invest £1,000, that £1,000 is distributed or is invested across these companies. The largest proportions go to the biggest companies and the smaller ones go to the smaller company. And it is not the case that that 1,000 is equally distributed across all 500 companies. If you go onto your Vanguard S&P 500 ETF, you'll notice that even though we say there are 500 companies, there are over 505 stocks or maybe 508 stocks because some companies list more than a single stock. Alphabet, which owns Google, for example, lists 2 classes of stocks. They have the Alphabet Class A and then the Alphabet Class C, even though they are the same company. So there are 500 companies, but about 508 stocks, depending on how many stocks a single company lists. Because the S&P 500 index is made up of the top 500 companies in America, it also contributes to about 80% of the total money in the US stock market. And so for some people, it's actually a measure of the US economy because it makes up about 80% of all the money in the US stock market. And so if the S&P 500 is going down, then literally it is the US economy that is going down. And because many things in the world depends on the dollar or depends on the American economy, for some people, because they have confidence in the American economy, they would rather prefer to invest in the S&P 500. Another index which you should be aware of is the Dow Jones Industrial Average, which is a price-weighted index. And this is made up of the top 30 companies based on the price of their stock. So it's made up of companies like Goldman Sachs, and others whose share are quite expensive rather than their valuation. And so it doesn't even include companies like Alphabet or Apple, because even though Apple is a large company, a trillion-dollar company, because their individual stocks are not as expensive as, Goldman Sachs, which is a small company, well, compared to Apple, but their stocks are more expensive. And so the Dow Jones Industrial Average is rather made up of 30 companies based on the price of their stocks. And so we can already see the problem with that, the fact that a company's stock is expensive doesn't mean it's the most profitable, or it doesn't mean it's the biggest. For example, it also contains Walmart, and Walmart is way larger than than Goldman Sachs. But Goldman Sachs stocks are more expensive, and so they are weighted more in the Dow Jones Industrial Average rather than Walmart. Even though Walmart is bigger than Goldman Sachs, about 4 times larger than that. So that is another index to be aware of. The third index, which you should know about, is the Nasdaq Composite Index. It is like the S&P 500, except that it is really made up of a lot of technological companies. And unlike the S&P 500, that includes companies that are listed on the New York Stock Exchange as well as the Nasdaq market. For the Nasdaq Composite Index, it includes only companies that are listed on the Nasdaq index. So we already see that, if technological companies are not doing well, as we've seen recently, the Nasdaq, underperforms. But because the S&P 500 includes companies which are both on the Nasdaq index as well as, the New York Stock Exchange market, it tends to do better than the Nasdaq index. And then the final one you should know about is the Russell indices. There are 2 types of this. There is the Russell 1000 index and then the Russell 2000 index. They combine to be known as the Russell 3000 index. The Russell 1000 index is like the S&P 500, but these are made up of the 1,000 largest companies in terms of market capitalization. So in terms of their valuation, their size. The S&P 500 represents about 80% of the American stock market. So if 500 is equal to about 80%, the Russell 1000, made up of the top 1,000 largest companies, makes up about 93%. So that may even be more reflective of the U.S. economy than the S&P 500. The Russell 2000 is made up of the smallest companies. So that is rather a reflection of the smaller companies in America, and so that can be a bit riskier to invest in. Where can you get an S&P 500 index to buy, or how can you invest in the S&P 500 index? The S&P 500 index has already been established, and there are people who are actively working on it because as it is made up of the largest 500 companies, if a company should be devalued and then it should be surpassed by another company, they would be replaced, So always it is the top 500 largest companies in America. So there are those who are working on that. But there are also these fund managers who simply, sit back and then copy what the S&P 500 index is doing. So they take people's monies and then invest for them by just tracking, by just copying, by just tracing what the S&P 500 does. And that is what we tend to do as investors. And one of these companies is the Vanguard S&P 500 ETF. So the ETF is simply copying, it is simply tracking the original S&P index. And that is why we are passive investors, because Vanguard is not actively, determining which companies go into the S&P 500. No, Vanguard is simply tracking, it's simply copying the S&P 500. And that is why their charges is also cheaper, because if you are to invest directly with those who are changing the companies, then that'll be more expensive because those are the active ones. But we do it passively by tracking them, by copying them. Other companies that also track the S&P 500 index is the Fidelity. So there is the Fidelity 500 Index Fund. Another is the Schwab S&P 500 Index Fund. Then we also have the iShares S&P 500. So there are a few of these, fund managers or brokerage accounts that track the S&P 500. But of course, the most popular one is perhaps the Vanguard S&P 500 ETF because of its low charges. In fact, there are some platforms who don't track the S&P 500, but they would actually sell you the Vanguard S&P 500. And one of them is like eToro, whereby you can get the S&P 500, the Vanguard S&P 500 ETF to buy on the eToro platform or any other trading platform. But you must beware of their charges also, because they will factor that in. Of course, this means that if you give your money or if you invest in a brokerage account that seek to track the S&P 500, but they are not very good at tracking it, that means that they will not return the same value as other brokerage accounts that are able to really track the S&P 500. And Vanguard S&P 500 Index ETF has been known to track the original S&P 500 index fund quite well, and that is why most people invest there. So, what are the advantages of investing in the S&P 500? Well, we already see that because it's a diversified portfolio, by putting in, £100 or $100, you already have, access to about 500 companies. So that diversification can be a good thing. So that if, one sector is not doing well, like the Nasdaq is not doing well, or the technology companies like Facebook, which has not really done well this year, you don't really lose much because other companies like, Mobile or Tesla or the other companies may do better. So it gives you that diversification. Another advantage is that the S&P 500 has been known to perform quite well regardless of the highs and the lows. It's historically delivered about 7 to 10% per annum, and that is pretty impressive. That is if you average the highs and lows. So that's a good thing. The third reason is that it takes a lot of the headache of investing away from you. Because Vanguard tracks the original S&P 500 index, you literally don't have to do anything. You just put your money there and they track it for you, and then they invest it for you according to the top 500 companies. So when you know where your money is, but then you don't have to cherry pick or choose these companies yourself. The fourth reason is that it's a good place to really start investing. As you start this investing journey, you get used to, understanding the graphs, understanding the charts and all of that. And perhaps at that time, you'll be ready to consider investing in some companies you think have potential. But while you are starting, it's often hard to understand these things, and it seems like a lot of information. So investing in the S&P 500 is a good introduction because you are sure that your money is pretty secure if you keep it in for a long time. And the fifth advantage is the frequent updates. Like I explained, these companies are often being reviewed, and some are being kicked out and some are being kept in. If the value of the company goes down and it's no longer in the top 500, it's kicked out, and then the strongest one comes in. So that can be a good thing. But it also comes with disadvantages, as we would know. The first disadvantage to the S&P 500 is that it's solely based in the US. So that for a truly diversified portfolio, you want to invest not just in the US market, but also maybe in Europe or even the UK or even in Africa or even Japan or China. So there are other indices that track, emerging markets like Africa, China, or even indices like FTSE 100, that is the top 100 companies in the UK. There's also the FTSE 250 developed world, which tracks the top 250 companies in the developed world. We also have the FTSE 250 developed excluding UK, which tracks the top 250 companies in the world excluding the UK. And I think these really help you, to have a truly diversified portfolio. Because while, of course, the US economy is strong and is big, anything could happen, so you may want to, invest in the US as well as outside the US. And that would really give you a truly diversified portfolio. And that is what I tend to do. I invest heavily in the US market because it's strong and I believe in it. But I also, invest in the UK market as well as in the developed world markets. Investing in the emerging markets like Africa or China can be tricky because these economies are quite unstable, and so it can be riskier. But it's something you can consider because if they do well, they tend to return quite a high amount. So all of this depend on your risk appetite. The second disadvantage, perhaps, is that the S&P 500 is not really a short-term investment. It is in for the long run. It is not a sprint, it is a marathon. Because you cannot really predict it. There are 500 companies in the fund. You couldn't predict that, Tesla stocks are going up, and so I'm going to, buy 10,000 pounds of it. If you bought that with the hope that Tesla is going to do well, Facebook is not doing so well, and so it will pull you down. And so really, to benefit from the S&P 500 is to invest for the long run. And so that can be a disadvantage for people who want, quick gains. It's not for the faint-hearted. It's for the one who can endure till the end. Um, And that also brings the third disadvantage, which is sector risk or the influence of large companies. Smaller companies have smaller share in the in the S&P 500, so that Harley Davidson contributes a small proportion to the S&P 500. And so if it is doing so well, the impact is not felt as much as when larger companies are doing well. Likewise, if larger companies are not doing well, they pull down your investments. So that can be a disadvantage also. The final disadvantage is simply the methodology of the S&P 500 in terms of they using the market capitalization in terms of the size of the company. There are some who believe that the bigger the better, or is too big to fail. Well, I'm not sure about that, whether big is always good. Sometimes the small ones can perform even better. That, that's always can perform better. There's an adult, adult joke alert. What type of account should you use to invest in the S&P 500? Well, you would notice that when you go onto your Vanguard platform, or whether eToro, or any other platform that you use, that you are given options whether to open a stocks and shares ISA, or a retirement fund, or a general investment account. And these are crucial that you select the right one based on your need. The stocks and shares ISA, which is perhaps the popular one, is because it is tax efficient. If you invest in the S&P 500 or any other stocks and shares through the ISA, it means whatever profit that you make is non-taxable. And when you sell your stocks or your funds and you make profit, no one will take any tax from you. So you keep it all. And you can access the money anytime you want also. So that can be a good thing. If you invest in the S&P 500 or any stocks through a general account, whatever capital gains you make by selling the funds, whatever profits that you make is taxable depending on your the tax brackets you are in. So that may not be very desirable that you are taxed. The third account to be aware of is the retirement account. When you go to your Vanguard platform or any other platform you use, you'll be given the option to invest via a retirement account. And what that means is that whatever amount you invest, the platform will claim back 20% of the taxes on that for you and then invest that. So if you put in, say, £80, Vanguard or any other platform will claim back 20% from HMRC and add that and then make it 100 and invest it for you. So we already see that that is a good way to multiply your investments and then gain a lot more. If you put in £100, they will claim 20% of that, and so they invest £120. Because it is a retirement account, it only means that you cannot access this money until after the age of 55. Be aware that from the year 2028, this age is going to move to the age 57. But that can also be a good thing, because assuming you are 30 years old now, it means that these investments will not be accessible until 15 years' time. So it is a way of locking yourself. And that can be a disadvantage if you are thinking of, getting your money sooner. But the good news is that you can invest in both a stocks and shares ISA as well as a retirement account. And that is exactly what I do. There is some of my investments in S&P 500, which are through the stocks and shares ISA. And so if I notice that after 10 years or after 5 years, the fund is doing quite well and I need the money, I can sell that and then take the money out and pay no taxes and then use it. But for the retirement account, I would have to wait until I'm 57, because I'll not be until 2028. I would have to wait until I'm 57, then I can start taking the money out. So you can do both, knowing that you have some in the medium term and some in the very long term. And that can be a good thing. When it comes to the stocks and shares ISA account, if you use that to invest in the S&P 500, you can take all the money at once and nobody will charge you anything and you take the money away. But if you use the retirement account, you should be aware that you can only take 25% of the money as lump sum. And then the rest you can withdraw over time, and then it will be taxed at whatever rate that, if you take, I don't know, 1,000, and you're a basic rate payer, a tax will be deducted from that. Or you can choose to take as much as you want, whenever you want, and always the first 25% will not be taxed, but the remaining will be taxed. There are various ways you can take the money out. The point I want to make here is that be aware that 25% of that money is not taxable, but anyone after that will be taxed at the rate. And you can only take it after 57 years or 55 years ongoing. I'll have a whole video on personal pensions, why I think you should do one and how you can go about it. In fact, there's another way to take out the money called annuity, whereby you take out the 25% on anything you want, non-taxable, but then you use the remainder of the money to buy an insurance that will pay you a salary until you die. And so that can be actually a good way to boost your pension income. So that is something to consider also. Let me know in the comment section if you'd like to know more about this personal pension. And while at it, kindly remember to subscribe to this channel and like this video so that we can reach more people. The final one, which I'll not talk much about, but I'll do a separate video on, is the junior riser, whereby you can have that for a child or somebody under the age of 18. So it's also a tax-free account to invest, essentially. So you can use a junior riser to invest for your child and already set them up to a good future. I would have a whole video on, investing for children. So do subscribe to this channel and look it up when it comes up. One other difference between the stocks and shares ISA account and the retirement account I need to mention is that with the stocks and shares ISA account, the maximum you can put in any tax year is about £20,000. But for the retirement account, you can put up to £40,000, but no more than about 1,073,000 over the life course of the investment. So I mean, if you've got more money, then you can put it in the retirement account, or you can share it according to however you want. And like I said, that's what I do. I've got some of my S&P 500 investments in via pension or retirement account, and I've got some in the stocks and shares ISA, with the hope that some I'll take the ISA one after maybe 5 to 7 or 10 years, and then the pension is for to boost my pension income. Now, how should you invest in the S&P 500? And here there are two main strategies. Either you invest a lump sum, so you've got 10,000, 20,000 pounds, you put in your S&P 500 account via Vanguard or something, and then leave it for 5 years, 10 years. It goes to the highs and the lows, but with the hope that over 5 years or over 10 years, it would have risen and you would have gained profits. So that is one. Or the second option, what is known as dollar cost averaging or pound cost averaging, however you want to call it. And that is a more consistent way of investing, especially for beginners, or if you don't have a lot of money to start with. With that, you put in a given amount every month, whether £100, £200, £300, you put it in at a consistent period. And what that does is that it means that at some point you will get the price of the stocks high, some it will be low, but it is the hope that over a long period of time it will average out. The disadvantage with the lump sum is that now it may be a good thing because stock prices are already low. So if you're buying it very cheap, and over time it rises, and so you gain more. But what if you buy it now and the stock prices don't go up? They rather keep going down, you would have lost. But if you do dollar cost averaging, it means today you buy high, tomorrow you buy low, you benefit from it whenever the prices are good or when they are bad. So that is something to consider. But given that stock prices tend to rise over the long time, it is the case that you gain whichever approach you want. So it depends on what money you have, as well as your strategy. To the final question, when should you invest? Well, I guess there is no better time to invest than now. And I know that it's cliche, but here I mean it literally. Currently, we know with all that is going on, stock prices are actually quite low, and they are predicted to actually fall. That means that you may want to be wise when you are buying it. You may not want to put all your 10,000 or 20,000 or whatever much you want to buy. You want to tether it. You want to maybe buy 5,000 today and then wait a couple of months and then buy another one to see almost like dollar cost averaging, to see if prices will come down and then you benefit more from it. But if you're confident that the prices are the lowest today, and so you buy and then wait that it will rise. But given that stock prices are down, I truly encourage you to consider investing in it. Buy some stocks now, and indeed the S&P 500 is a good one that gives you a diversified portfolio. But even more, perhaps consider other other indices. If this is something you'd like to know more about, do let me know in the comment section, or you can go onto my banner. You can have my Facebook link there, and then we can have a discussion as to which other funds I invest in, and I can share this with you on a private level. Because of the number of people who have reached out to me to show them how to invest in the stock market or even invest in the S&P 500, come Friday 7 p.m. GMT, I'll host a live show where I'll take all your questions that you may have about investing in the stock market or even investing abroad. Do let me know, and then let's make a date, and then I'll answer all questions that you have. Or even if you have other ideas about other investment options that we are not considering, do come around, and then I'll be able to share all of these. I hope you found this video helpful, and I look forward to catching you at the next one. Stay blessed.